Welcome to today's deep dive. Before we jump in, you know the drill, right? We're not licensed advisors, and this discussion is strictly for educational purposes. So yeah, absolutely not financial advice.
Right, yeah. Keep your portfolio strategies to yourself. We're just here to analyze the data today.
Exactly. And wow, the data here is wild. So picture this. August 4th, 2026. Broadcom's stock suddenly spikes 6.61%, closing out the day at exactly $418.16. A massive win for investors, right?
Yeah.
But the strange detail is, Broadcom hadn't even released a single piece of news.
Yeah, they didn't have to. It was like a classic sympathy rally. Palantir had just released blowout earnings, which kind of proved that commercial AI software demand is actually translating into real dollars.
Right, the money's actually showing up.
Exactly. And that proof immediately eased broader market fears, lifting AI hardware stocks right along with Palantir.
It's fascinating how a neighbor's good news can instantly add, billions in market cap. But we're here to see if Broadcom actually justifies that valuation on its own merits today. And looking at the mechanics inside Broadcom, they are pretty staggering.
Oh, for sure. I mean, look at Q2. Their AI semiconductor revenue hit $10.8 billion.
$10.8 billion. That represents, what, a 143% year-over-year increase?
Yeah, 143%. It's huge. But what really caught my eye is CEO Hock Tan's roadmap. He's projecting a clear path to exceeding $100 billion in AI chip revenue by fiscal 2027.
Wait, $100 billion by fiscal 2027?
Right. And that projection is largely backed up by their current $73 billion backlog.
Okay, so it's basically like a sold-out stadium world tour booked years in advance. But see, here's where I get hung up.
Go for it.
Almost all of that projected $100 billion target relies on just 6 core hyperscaler customers. Just 6. If one of those giants decides to pull back capital expenditure or, I don't know, start building chips entirely in-house, doesn't that massive revenue pipeline just evaporate?
I mean, yes, it's a heavy concentration risk, absolutely. Your entire fate is tied to the CapEx cycles of half a dozen tech giants. But the defense against that is Broadcom's specific business model.
How so?
Well, they aren't just selling off-the-shelf parts. They co-develop these custom chips alongside the clients.
Okay, so it's less like buying a standard server rack and more like pouring the concrete foundation for a custom skyscraper.
That is exactly it. Once a hyperscaler commits to Broadcom's architecture and integrates it that deeply into their data centers, they can't just swap in a competitor's chip, not without tearing down the whole building.
Right, the switching costs are astronomically high.
Precisely. They are functionally embedded in the client's infrastructure.
Okay, but if they are that deeply embedded with these 6 giants and have $100 billion locked in their sights, why is Wall Street suddenly getting cold feet? Because despite that internal engine, they're hitting some massive external speed bumps right now.
Yeah, they are. The biggest hurdle is over in Europe. There's an intense European Union regulatory probe regarding Broadcom's acquisition of VMware.
Right, and they just lost a legal bid over that, didn't they?
They did. Broadcom tried to claim U.S. attorney-client privilege for their internal communications to block the EU's demand for U.S. legal documents.
And the EU courts just flat out rejected it.
Flat out rejected it,
Yeah.
because the European legal framework views in-house counsel fundamentally differently than the U.S. does.
Wait, really? How different?
Well, in the States, your internal corporate lawyers have strict attorney-client privilege. The EU, however, often views in-house lawyers simply as regular corporate employees who, lack the independence of outside counsel. So that protective shield just doesn't exist over there.
Oh, wow. Meaning Broadcom is being forced to hand over highly sensitive internal strategic communications to regulators.
Exactly. That creates a massive black box of uncertainty for investors.
And that uncertainty seems to be bleeding over into broader market sentiment, considering Goldman Sachs officially removed Broadcom from its August U.S. conviction list.
Though we have to look at the mechanism behind that removal. Goldman isn't saying Broadcom's fundamentals are broken.
No. Then what is it?
It's a broader portfolio rotation. Fund managers are looking at high-flying tech valuations, locking in those massive profits, and rebalancing their risk toward cheaper defensive and industrial sectors ahead of potential rate cuts.
Okay, so you're looking at a company exposing its private legal playbook to the EU, while major funds are actively rotating capital away from them. How do you weigh that against the sheer stickiness of their custom chip revenue?
Well, if I have to deliver a numeric score based on the source data, I rate the stock an 8 out of 10.
An 8 out of 10, that high.
Yeah.
Even with the regulatory exposure.
Yeah. The reasoning comes down to visibility. The unparalleled visibility of that path to $100 billion by fiscal 2027 fundamentally outweighs the near-term overhangs of the EU legal drama and the Goldman Sachs portfolio rotation.
I guess the revenue is just that locked in.
Right? The concentration risk and regulatory fights are absolutely real, but the contracted embedded revenue growth is simply too massive to ignore.
And we're going to see exactly how massive on September 2nd, which is their next crucial earnings date. And as you watch this space, here's a final provocative thought to mull over for yourself. Will that September 2nd report finally force the market to judge Broadcom on its own massive fundamentals rather than relying on its peers to lift the stock?